All right, so it's been almost 6 years since I bought my first home, and it's been almost 5 years since I became a mortgage broker owner. And so there's a lot of things that I didn't know when I bought my first home, and also what I've learned helping over 500 clients buy a home or refinance their home as a broker owner. And so, in 2025, if I had to buy a home, there are a few things that I would have done a lot differently because of the fact that I have some information that I didn't know back then. And so in this video, I want to share with you 4 key things that I would do as I jumpstart to wanting to look to buy a house, okay? And the very first thing that I would be doing is I would be trying to identify my comfort payment zone. My comfort payment zone. This is typically something that a mortgage broker or a loan officer is going to help you do through the pre-approval process, but you could easily do it yourself if, it takes a little bit of math and stuff, but it's not too hard. And so the first thing to try to identify what your comfort zone or your payment comfort zone is going to be, your monthly payment comfort zone, is you have to first understand what your gross monthly income is. Now, if you're on a salary, that's pretty easy, right? It's going to be whatever your salary is divided by 12. If you are hourly, the best thing to do is to look at your total last year's earnings, okay? Whatever your average earning is for that last year, and just divide it by 12. Or, you can think of it as if you've been tracking with OT and everything pretty consistently, and I'm not saying in recent, last couple of weeks, but let's say the last 6 months, that's when your pretty typical annual, or not annual, but your gross monthly payment, and then on your pay stubs, then that's going to be your monthly pay. And so I want to take my gross monthly pay, and then I'm going to calculate it by doing about 40 to 50%. So in the lending industry, typically about, the average that we're going to allow for anybody to have a monthly expense against their gross monthly income is going to be about 40 to 50%, depending on the loan product. For yourself, it's going to be all dependent on your comfort zone. That's why we're calling it a comfort zone. Typically, people are targeting about 30 to 40%, but if you want to do the maximum, what can I afford scenario, then it's going to be 40 to 50%. So let's say I'm earning about $120,000 a year gross annual salary. I'm not including the bonus and stuff because I don't know everybody's bonuses, and depending on what type of bonus it is, if it's stock, restricted stock, if it's cash, you didn't get bonus last year, but you're getting this year, all that is variable, right? So the ones that I know is fixed is going to be your salary. And so based on your salary, if it's $120,000 a year and you're earning about $10,000 a month gross, I would say 50% or 49.99, whatever it is, but 50%, let's say you start there, okay? And now you have a number, which in this situation would be $5,000. And then from there, I'm going to start subtracting out, okay? Subtracting out monthly payments. Now, the monthly payments that we as mortgage lenders are going to be looking at are going to be things like credit cards, student loans, right? Car loans. Now, things that are not going to be included in it is going to be things such as your cell phone bill, okay? But unless you have a cell phone bill, but if you are financing your phone, let's say not through your cell provider, but through a loan, then you're going to have to consider that. But typically not a cell phone bill, not your utilities, anything else, where you have to include your alimony if you are paying alimony in those situations. Now, so I would deduct my $5,000 and then deduct student loans, car payments, credit cards, monthly minimum payment, if there's alimony, anything that you are committed to paying. And then the leftover is basically going to be your total housing expense, okay? And that's what we are looking at to figure out what your possible loan approval amount is. So your monthly housing expense, that's what's going to be left over. And so I'm going to take that, okay, and then I'm going to go into step 2. Step 2 is going to be trying to find a mortgage calculator. You can find, pretty much anywhere on the internet now, right? On bankrate.com, mortgage news daily. There's a bunch of mortgage calculators. And what I'm going to try to do is try to figure out, based on the current market interest rate, how much loan can I get based on the the mortgage, the comfort payment zone that I just identified, right? The 5,000 minus all those expenses, and then whatever that leftover amount is. Let's say it's $3,500, right? Housing expense. So based on that mortgage payment, right, with your insurance and property tax and stuff, based on that payment, I'm going to try to see, okay, let's say the average rate these days is, 6.25% or 6.5%. What does that equate to in terms of a mortgage, of a loan amount? Now, pretty standard is a 30-year fix, so I would just stick with that. Don't get too fancy with adjustables or any other terms, but let's say 30-year fix, what is that loan amount? And that's going to give you your possible maximum loan amount. Now, the step 3 from that is then I gotta have to take a look at how much did I save, because buying a house is gonna cost you some money. There's closing costs, property, which includes property taxes, title, and all that stuff. But then there's also going to be, depending on the loan product you get, down payment. Right? A conventional for a first-time home buyer is typically 3% minimum down payment. If you're not a first-time home buyer, for conventional is 5%. And then for, if it's FHA loans, then it's 3.5%. If it's VA, possibly 0%. So depending on your cash to close that you need, your down payment plus the closing cost, that I would say it's going to be your down payment plus about 3 to 4% of the purchase price, right? So just think of it that way. And so if you're thinking 20% down, then your total cash out of pocket is typically around 24%. If you're thinking 3% down, the minimum down payment for a first-time home buyer, then your typical cash out of pocket is going to be about 6 to 7% of your purchase price, which is again down payment plus your cash to close, your closing cost. Okay. And so based on that, then I know now, okay, so loan amount, your down payment plus your, closing cost, which is about 3 to 4%, that's now going to be my purchase price. So now I know the price of the home that I can afford. All right. So then I'm going to take that number and it's going to move on to step 4, the final step, which is then either I'm going to connect with a realtor, which I highly recommend because they have availability to listings that's not even on the market yet, that you can't see on Zillow yet. That's going to be basically like pending, coming soon type of stuff that you won't see. And so I highly recommend connecting with a realtor, interview a few of them. You got to have that chemistry, right? And typically what I share with and advise folks is to look at things like communication style. When are they working? Are they available on weekends? Are they available at nights? How good are they educating me and answering the questions that I have? And so, interview them, find a realtor. And then if you're in the DMV, just ping me and I can advise you. Or if you're in Florida, in Jacksonville County, I can advise you with some realtors in those areas. But if not, just find a realtor. But if you don't want to and you want to start with Zillow, at least you know what your then maximum purchase price amount is. And so that's the first thing that I would do if I was to buy a house in 2025 is kind of sit down and go through the math. It only takes about 5-10 minutes really to just go down the math to see, okay, how much can I really afford? Is now the right time? Do I have enough money saved up for the down payment and closing costs? The big myth out there, a lot of people is they think, you need to save 20%. That's not true. Or if it's less than that, you have to go with FHA. That is also not true, right? Because there's 3% first-time homebuyer conventional loans that's available as well. And then also there's all these, incentives that you can dip into or negotiate with sellers for seller credit to help you with closing costs and all that stuff. So there's all these other mechanics, and that's why you got to work with professionals and not try to all figure it out yourself. And even if you are using like ChatGPT or trying to find information on YouTube, like you did find this video, there's a reason why there's professionals that do this day in and day out, walking you through all these scenarios and all these tips and tricks and stuff to try to figure out like what's the best situation for you. And then also, making sure that the realtor is partnering with your loan officer so that they can team together to structure something, right, on the negotiating side with the purchase, but also on the loan side so that it can be the most advantageous for you. So 2025, if I had to buy a house, those are the steps that I would be considering. If this was helpful, there's a link below for a free guide for first-time homebuyers. I mean, you don't even have to be a first-time homebuyer. You can be a veteran, seasoned homebuyer, and this could be your second, third, fourth home. But I think if there's valuable information there, as well as a checklist into there on I can't remember if it's like page 20 or something. It's pretty intensive, or not intensive, but extensive for you and comprehensive. So feel free to download it. I think it's only going to ask you for a name and an email, and you're going to be able to download it right away. It's free of cost, so feel free to check the link below. And yeah, appreciate you, and stick around. Talk to you later. Bye.